Hey guys, thank you so much for joining me. My name is Ann Kimani and this is Aaron Kimani, and I'm super excited about today's topic. Saving and investing in a money market fund is actually one of the most simplest investment product or option that we have. And so maybe you are there and you have some emergency savings in a particular bank, or maybe you have some little money, 5,000, 10,000, 20, 50, 100,000, and maybe you're trying to accumulate it to be able to invest in a bigger investment, and you've saved that money in a bank account, whether savings or current account. So let's talk and see, why does your money needs to be lying somewhere? Instead, you could be saving it in a place where it's accumulating or it's giving you a return every single day. And so we'll be looking at what is a money market fund and why is it popular, why do people prefer money market fund than other options, and also we'll look at maybe in another video how do you join a money market fund and what are some of the things that you need to consider and some of the things that they can't tell you, but we can have a discussion so that you're more informed about money market funds, right? So I know many people actually don't know that there are also other types of funds in the market, as in money market funds are so popular that actually they overshadowed other funds, right? We have the bond fund, equity fund, we have a balanced and managed fund. You get a money market fund is a type of a fund under unit trust. So unit trust is the umbrella, unit trust is the mother. So that's why you find under unit trust now you have money market fund and other types of funds that I've mentioned. Let's start by defining the unit trust, the mother, the umbrella, right? So a unit trust is basically a collective investment scheme, or in other words, it can be called like a financial vehicle that pool money from different investors, could be big or small investors, with an objective to invest this money in financial securities like the likes of bonds, corporate and government bonds, and likes of stocks, that means shares, maybe another financial asset. Unit trust in Kenya are actually licensed and regulated by the CMA, that is Capital Markets Authority, and they're usually run by professional investors. As Anne, I bring in my 5,000, you bring in your 50,000, someone else bring in their 1,000,000 Kenyan shillings, someone else. So all this money, they are pulled together. Then these professional investors take our money and be able to look for viable investment options, invest the money on our behalf, of course, make the decision of negotiating, moving money around, trying to see which is a better option, buy, sell. So they do all that on our behalf. Of course, it's like a management fee over there. We'll get into that. So they do that on all our behalf, right? So that is what unit trust is all about. And so you find now under unit trust, now we have the likes of money market. So what differentiates different types of funds like money market and bond fund is basically where the investor's money is going to be invested. So you find in a bond fund, the money will be invested in bonds, right? So you find in an equity fund, the money will be invested in the stock market or the buying of shares. So you find now we come to the money market funds, the investor's money will be invested in short-term securities. What do I mean by that? So short-term securities are those securities that should mature within an year, right? It include the likes of treasury bills. Treasury bills is basically how the government raises money, so they lend to the government. So another thing that the money market funds, or where the money is invested, it goes to commercial papers. So commercial papers are also lending to big corporates or high profile corporates to be able maybe to take care of their cash flow. They also invest the money in the fixed and call deposits to the commercial bank. So basically in money market fund, the professionals invest our money or investors' money in securities that will mature within an year. Clear? So what all this does, or what these funds does, is they're able to give the individual and retail investors an opportunity to be able to invest in those securities that if you are to invest by yourself, you couldn't have afforded. Because, for example, let's take a look at treasury bills where they invest for money market fund. For you to invest in treasury bills, you need 50,000 Kenyan shillings. So you as an investor, you may not be able to accumulate that, or you may not afford to have that. So they combine my money, yeah, right? The power of pulling resources together, and they combine my 5K and your 45K, then they another person's million, then they're able to invest in these treasury bills. You get? So they give every single person an investor to invest in those securities that you could not have managed, either because the money is not enough, or even maybe professionalism, expertise. You're not able to make a decision and be able to know which one should I invest in. They're giving you that expertise and experience. They're making decisions on investing on your behalf, right? The other thing is the economies of scale. If I'm to invest by myself, there are charges that I might incur, right? Which maybe if we are many, the charges will be less, and also there's a return I could have gotten. If I had bigger money, I could have gotten more compared to my little money. So you remember when we have the capping of the interest rate to the commercial banks could not afford to be able to pay depositors a certain amount of interest, right? That time they were required to pay 70% of the CBR rate, that is central bank rate, and they couldn't manage. So after the capping of the interest rate, what the banks did is they scrapped off, or they removed most of their savings account, and now they had to popularize the fixed deposit accounts, right? So you find, even though you have 50,000 or 100,000 or $1 million in a bank, you rarely get to enjoy any interest. Actually, you go after 2 months or 3 months, your amount is the same or even less in case there are ledger charges or the ledger fees, right? So you find after all that, the depositors had to look for an opportunity where they could put in their money and earn some return, or earn some returns. And that's why they realized money market funds now also had to restructure and now give these depositors an upper hand and tell all depositors, bring in your money, will give you a higher return. You find in the banks, when they give you an option of fixed deposit, the rate is usually determined by how much are you putting, and most of them tell you have to put maybe, let's say, 200,000, 500,000, a million Kenyan shillings, 100 million. So it's determined by how much you're putting and how long you will fix your money there. When you come to money market fund, you can actually put your money, for example, as little as 1,000 bob, and every single day that 1,000 bob is getting some interest to something we call daily compounding, right? The banks don't do the daily compounding with your little savings. Here, you're being allowed as a small investor to bring even 500 or 1,000, 10,000 to be able to enjoy the compound interest that they give. So you find that in money market fund as well, the return is higher compared to the bank. And even as we go talk about the return, until today, the banks have never managed to hit or to beat the rate that the money markets are giving currently. You find the average, the banks can only give you about maybe 6 point something percent, but when you come to money market funds, the average is usually 9.5. even some money market funds give you a yield of 10%, 11%. So that's the reason why you find many people would prefer to take their little savings or their money in a money market fund, because there is a daily compounding. You're earning interest at the end of every single month that they compute, right? So that's the reason why they became so popular. So why do people choose money market funds instead of other investment options or a savings account? Because again, there are other options. There's the fixed account that we've mentioned, there's the likes of stock market, there's the likes of treasury bills and stuff like that. And the very first thing is because the initial investment and the additional investment, the minimum amount given or required is usually very affordable to almost every Kenyan. As I've mentioned, some funds actually, for you to join, you just need to activate your account with 100 bob. Others is 1,000 bob, others is 2,500. So the most expensive fund that requires a big investment or initial amount is actually 10,000 Kenyan shillings. So it ranges from 100 to 10,000 Kenyan shillings, and some funds also put minimum amount that you can top up. So some put 100, you can top up 100. Others put like you can only top up a minimum of 5,000. So it ranges between 100 and 5,000 Kenyan shillings. So you find if I was to invest my money in treasury bills, there's no way I'm going to start with 100 bob. The minimum for treasury bills is 50,000 Kenyan shillings. So the fact that it's giving me a platform to start with the minimum that I'm able to have with such minimum amount, then it's a good opportunity for me. The other thing is a liquidity bit. In money market funds, you can be able to access your money as soon as you need it. Then that means right now many of them are really trying to give a 24 hours. After you do an email to the fund manager, you just write an email that you need to withdraw some money. You can either withdraw part or full of your money. You just need to write an email within 24 hours, but most of them you are able to access your money between 2 to 4 days, 2 to 4 working days. So it's easier because you find, because of that liquidity, people are able to feel free that at least even though you had already planned yourself, you have no pressure to go withdraw that money. You can always plan to get the money. Of course, don't save it if you know you will need that money, like it's like really emergency and you need the money, maybe for a business, there's a deal that is coming and you need that money. That may not be a good idea. So it could be a good idea for people with surplus money in their businesses, for people if you're saving for your chama, like you have a group you're saving, you can bring in the money. Then many people use it for to achieve their short-term goals. It's like the likes of paying school fees, right? For example, the quarterly expenses, maybe saving, you want to buy for example, a car, or you're saving for a wedding, or you're basically those things that you know they are short-term goals. So even paying school fees, so many people normally save towards that, because you know there's no point of me saving this money in a bank to pay school fees in 3 months to come. Then the money will be the same. If I'm saving 100k, it will be the same 100k when I'm going to get it off. But when you go to save in a money market, you'll get your 100k plus some interest on top. The other item is the daily compounding that we talked about. Every single day your money is earning interest, every single day. So there's the daily yield, and also there's an annual average rate. So every single time your money is in that account, you're earning interest. And even by the time you're withdrawing your money, I forgot to mention that, your interest, you will earn interest as of the last day that the money was in your account. You find in the, like for example, in fixed account, you withdraw your money before the time, then you don't earn any income in it. Like there's usually a lot of crazy implication if you withdraw your money before the time that you have agreed with the bank. So in here, if you need your money, you can withdraw, and you will earn interest as of the last day that you have withdrawn your money. The other thing is a kind of diversification it's giving you, because your money is not just going to be invested in treasury bills or in commercial papers. It's just going to be diversified. So you find many of them invest their money in treasury bills with a bigger portion. The other one goes to investing in the bank, the other one goes to the commercial papers. So normally, and most of the time, you find that diversification helps you, that if commercial papers or if these corporates don't pay back the money, at least the treasury bills will pay. So when you're spreading your risk, rather than if I was to save myself in, for example, in one of the securities, then that one fails, then I'm done. Like I've lost everything, right? So there's that diversification, and also professional expertise. As I mentioned, it's usually run by professionals. So that means they're talking, or they're investing from a point of information and experience as well. So they're able to make decisions even when there are changes in the market exchange rate. They're still able to make decisions and move money around and still make sure that you get some returns, right? Other than the bank, also money market funds are considered very safe, and because you find corporate, they're investing in securities that are also a bit safe. You find treasury bills are safe. The government will always, you rarely find that the government is very broke to pay back the treasury bill. So whether we have what type of president or what, the government is the government will pay money. Usually people don't lose their capital in investment. I think that's a better way to put it. You find if I put my 10,000, there's no way I'll come back and I'm told you have lost the money, now you will get 8,000. No, you will get your 10,000 and then some bit of return. Maybe the return can reduce, but I will always be guaranteed of my capital investment. Such institutions will pay, because also they are very short term, right? So I think those are the main points why people opt to go for money market other than other savings investment. In the next video, we'll be talking about how do you join a money market fund, and what are some of the funds that are available, and also what are some of the factors to consider. So see you in the next video. Bye.